I wanted to get your views as to what the Federal Reserve is doing and indeed what message it's sending out and how it affects the way you look at the investment world.
Well, if you remember, about a year ago, we were talking about this, and I was saying that
clearly we don't
it's a good chance that they're going to keep on raising rates in order to solve the inflation problem. And that's what's happening. Everybody was expecting a downturn in the rates, but in fact, the rates are going up, or at least it looks that way. But there's no question the game plan is that in order to solve inflation, you've got to keep on raising rates. So if the inflation is at 5%, you've got to go up to above 5. And if it's 6, you've got to go above 6. And of course, that leads you to even 8%. So I think it just depends on what's happening to the CPI, what kind of numbers come in.
There seems to be a lot of flip-flopping, though, I guess you could call it, in the forward guidance, right? First, it was, things are, this disinflationary trend, and then you have the data in January, and then things are stronger, and then now they're saying we essentially have to go higher and faster, but they're data dependent. Does the Fed essentially have to hike into a recession just to gain some credibility back, Mark?
Well, their game plan is to solve inflation. Now, it's true that they have a dual role. One is to watch the economy, and one is to solve the inflation. But that's a conflicting role, basically, because if you want to solve inflation, according to their rule book, you've got to keep on raising rates. And of course, don't forget, there's a political element here. They don't want to damage the Biden administration by raising rates too much and killing the economy. So it's really a conflict. And I would say that they're going to continue at this path in being very careful about raising rates. But at the same time, once the election is over, then they'll go full gun and raise rates to where it will have some impact.
And of course, it'll have an impact, Mark, on what happens in emerging markets, where naturally that's your bread and butter. So tell us about that, and also whether that perhaps headwind can be somehow the other mitigated by the China reopening story.
The interesting thing about emerging markets now is that many of these countries are actually lowering rates at this stage. Now, that may be premature on their part, but they are more concerned about their economies. Central banks in emerging markets are worried about their economies and therefore are actually lowering rates. So that looks pretty good for a number of countries. But at the same time, if the U.S. goes too high on rates, then many of these countries will have to follow. The good news is that actually the markets are not reliant on rates. In other words, the correlation between the market movements and interest rates really is not very close at the end of the day, if you look at history. So you'll see that emerging markets are now beginning to outperform the U.S. market, at least the S&P. The emerging markets are doing quite well.
So is there, if they're less sensitive to the rates environment in the U.S., I'm wondering, are they more correlated to the China growth story then? And is that how you kind of tilt your investments now, Mark?
It's not only in China. Of course, the recovery in China is helping a lot of these countries here where I am in Thailand. That will be very good for the Thai economy and the rest of Southeast Asia countries. But you must remember, India is coming up. Brazil is doing very well. These big countries are doing fairly well at this stage. Interestingly enough, a week ago, I was in Rio de Janeiro and Sao Paulo, and I was surprised to see that inflation in Brazil is actually lower than in the U.S. So they're in a pretty good spot to lower rates if they want to.
So, Mark, what sort of investments do you have right now in portfolios? How much are they geared towards China currently? And if so, whereabouts and what particular industry groups in particular?
Well, the tech industry, of course, is number one for us, particularly anything related to semiconductors. As you know, both the United States and China are putting enormous amounts of money into semiconductor research and production. Therefore, companies related to that area, whether it be hardware or software, are going to do very well going forward. So that's one area that's very important for us. And if you look at our portfolio, you'll see that that's the number one category that we have in our portfolio.
You have talked about you're turning a little bit more positive on China, though your allocation to the mainland remains the same. What would you need to see, Mark, for you to actually add more exposure and your allocation to China? And when would that happen, you think?
It's now happening. In fact, we're looking more and more closely at Chinese stocks. Well, it depends on what you describe as China. Taiwan is now our largest allocation. Of course, it's Taiwan province of China. So, in fact, we're getting this exposure to China through Taiwan. And, of course, as you know, China is Taiwan's biggest trading partner. And more of that will be coming as you see this development in semiconductors.